Hello, today is April 30th, Saturday, 2022. The weekend report title this session is Ugly April, setting up for a good risk reward long term. Hi, my name is Jonathan Gurney, Portfolio Manager of Gurney Financial. The disclosure statement. This post is for informational purposes only. The views expressed are those of the author, Jonathan Gurney. That is me. The material is not intended to be relied upon as a forecast, research, or investment advice and is not a recommendation, offer, or solicitation to buy or sell any securities or to adapt or adopt any investment strategy. This is basically for clients, keeping them aware of the game plan, the things that I'm seeing. So just want to keep you posted throughout the week, show you what I'm seeing, and we will go from there. All right, so let's hit the charts. The first chart that I want to kind of show you is the performance of the 4 core United States indexes. This shows the 1 day. Obviously, this is ugly. This is the biggest drawdown, single day drawdown since June 10th, 2020. And those were bad periods. But I do believe that this presents some nice long-term risk reward. That doesn't mean this is the bottom. I added 45%, actually 44% into the close. So we're down a little bit, but actually after hours we are positive. But I wanted some exposure because we avoided this entire week. So the 5-day performance shows the indexes. Our benchmark is right here. The S&P 500 is the ticker. The NASDAQ is mainly growth companies. So if you look year to date, we are in a correction within the NASDAQ. They're stupid titles, but anything over 20, they call a correction. So regardless, they're all titles. The average intra-year decline is 14%. So people are freaking out because last year our biggest decline was like 3, 4, 5%. So the reality is this is normal, but people are not used to it because they got so accustomed to being able to buy whatever the heck they want. And now they're realizing once the core companies and the indexes go down, look what happens. So the core 10 companies make up about 25 or so percent, maybe a little bit more. Here's the core 5. Apple, Amazon, Berkshire Hathaway, Facebook, Google. There's 2 technical companies that make up, we won't even go over that, but they both are separate companies. Microsoft, Nvidia, Tesla, and United Health Group, sorry. And you can see the 1-day performance is ugly. Year to date is pretty ugly as well. So the summary is this. Number 1, the month was awful for individual companies. And if these companies are not doing well, what's going to happen to the index when they are 25% of the index? It's not rocket science. So I definitely watch these core companies to see how they're doing because it matters, period. The index will struggle to keep pace if these are going down, okay? So we got to be real about that. So long term, let's look at the charts. Actually, I want to show you our performance. I forgot to show that to you. So here's the chart. Since September 3rd, 2021. I'm glad we're beating the index. There definitely have been some better times. There's some things that I would obviously change, but the strategy is working. The strategy that we've implemented is definitely working because the S&P 500 averages about 10.5% since like 1986 per year. That doesn't mean each year is up. It's going to be up 20, down 10. You get the gist of that. But overall, before this strategy, I was basically trying to trade 30 companies within a portfolio that has historically done pretty well, but this is not the right environment for that. This strategy I probably will stick to long term because it's working quite well. And if the index or benchmark is efficient and we're beating that, good things ahead, right? So we got to be real about that. So again, this shows the S&P 500 each day. There were opportunities, but we're still in a downtrend. You get a pop like this, institutions are selling this hard. I mean, we had the single day biggest drop since 2020 which was a true recession. this is just ugly. So I added at the very, very close just to say I was 100% cash. So at these levels, it's getting not too bad risk reward. I'm seeing the fear out there. We're getting downgrades when a company has a horrible report and then the analyst comes out with a horrible report. It's a joke. It's like you're now saying it's going to be horrible after it's horrible. That doesn't help anybody. And usually we start to see a turnaround. People are now saying that all these big institutions are lowering their targets from 5,000 to 4,500 for the end of the year. This is the stuff that you want to see to start saying we're starting to see blood in the street. So that's not bad risk reward. So I added 44%, almost 45% to the portfolio right at the close. You can see we're down a little bit, but again, after hours, we were positive. So on a day like today, if you can stay out and avoid most of the mess, these are not bad long-term entries. Do I think we will go lower? I do think there is a high probability that we could go a little bit lower. What I want to see is a big red open. And if it does, I'll add more, which is why I added some, not half, but some, and I can add lower. We do have the Fed meeting coming on Wednesday. That'll be crazy, but I'm hoping a lot of the bad news is baked in. So I'm going to switch gears. We're going to shift to the actual charts themselves, and we will get moving. Okay. So let's shift gears. There we go. Okay. Long term, we know that the trend is up. This is the benchmark. This is 20 years. The trend is up. Long term, not a debate there. Midterm, this is what I basically watch very, very closely. Like, whoa, that's a lot of lines. We're in a downtrend, period. We are trending down. We broke the channel and we are now at right around, let's call it 41.50. It closed at 41.31, but I do believe the 41.50 will be tested much harder coming Monday. Doesn't mean it'll hold, but I basically wanted to buy this down trend line, and we did right at the close. One thing that I'm really watching is this slow burn RSI midterm. This is not what you want to see. It's a slow drag. You get pops like we did on Thursday, but we are not holding the 5-day moving average. As we've spoken about, the 5-day moving average is the short-term trend line, this orange line. You can see it a little bit closer right there. It's now at 42.21. That's a big spread from where we closed. So usually when you get a big spread like that, you might get a little bit relief, just like we did Thursday. So we are in a downtrend. It doesn't mean it's going to last forever. This is not a bad risk reward level to get in, which is why I did. So I believe 44% is the right mix. I think it's very probable that we could go to 40.86, which is right here, 40.86, below 4,100. You got to extend the chart long term to even get to that. So that's going to cause some bearishness. Again, when things are good, things go higher than you expect. When things are bad, things go lower than you expect. That's just how the market works. There's nothing like price to change sentiment. When things are bad, people sell. When people are good, people buy. It's just normal psychology. So we went over long-term, midterm, short-term, risk reward. Okay. So risk reward is actually not bad here. I do think we go lower, but some things that I'm always looking for is number one is the midterm chart close to oversold, and we are very close. Oversold is 30. We're at 34. The VIX fear index is over 30. That's what I've been talking about. We want over 30. We are over 30. The put call ratio, the amount of protection or people just betting against the market is near over 80. We're at 78. So it's an okay risk reward. The National Association of Active Investment Managers is below 50%, which is again bearish. And all of these other charts basically showing high lows in the NASDAQ, the New York Stock Exchange. This keeps you out of trouble when you see the general trend is down. You have to be real about that and not fight that. You're going to get pops. I mean, we had a huge 10% pop, but it's still in a downtrend. Okay, so we got to be real about that. We will have better days ahead, but it's getting pretty extreme to levels where it's like, okay, I think with given all the data, this is not a bad place to put some to work. Even if I held here and never sold, if we go below 40.86, we have problems. I'll get back out, but I gotta have some exposed here. To win, you have to participate at some point. So the downside has never been the issue. It's been the upside for me that I need to improve on. So I need to force myself to add a little bit here and just say, you're not going to time this thing perfectly. You're going to add slowly on the way down. And we've obviously not been perfect on the way down, but we are preventing a decent chunk. So have a great weekend. We'll continue to work on trying to make these videos shorter, but overall, this is not bad risk reward. One thing I do want to give you for some optimism is the S&P 500 is corrected 13%. It's a little bit more than that now. The average year decline is 14%. We discussed that. By the way, he's a great follow on Twitter. He's a really nice guy. Ryan Dietrich. I'm not sure if that's how you actually say his last name, but really nice guy. Very great. Some great material online on Twitter. Here's the stats. Basically, 12 of the last time stocks came back and finished positive by year end. Kind of interesting. So don't get too bearish here. In fact, up 17% on average at the end of the year, 12 of those times. So don't get too bearish. The gold line is basically showing the average intra-year decline and the typical performance thereafter. To be honest with you, it's not bad that this is happening earlier in the year. People will look and say, how do we get out performance and start to add? Institutions right now, though, I got to be real and be honest and say, let me shift gears real quick and I'll show you. There were some periods where we would go up like 0.25% and in 5 seconds go down 0.50%. When I see that, it is retail buying, trying to time a bottom, and institutions selling. When I see a 5-second dip that fast, that is institutional selling. You get out of the way and just try to add later when things calm down. I literally added, I think, at 3:50 just to make sure I got an entry. I knew it wouldn't be perfect, but it's not a bad long-term trade. So as we discussed, April was brutal and hopefully next month turns around. But again, we have to see buyers. If we don't see buyers, don't fight it. I want to put some to work because it's a good long-term opportunity, but I'm definitely not going 100% into this Fed meeting. I'll probably, even if I get some gains quick, I'll probably take some off just to be careful. So have a great weekend. We're going to hang in there. The strategy is working. I just need to get better on the upside, period. It's not the downside that everybody's worried about. It's the upside. So remain optimistic. We'll be okay. And understand that this is not going to turn around in 1 to 2 days. This is not 2021 or 2020. This is going to be a year where it's going to be a struggle, drive everyone nuts, and you'll probably get some nice gains in 2023. That's just the reality. We just have to kind of survive this year. Have a great weekend. Thanks, guys.